Picture this for a moment. When the market closes and the headlines fade, real decisions don't happen in public. They happen in silence, behind screens filled with numbers, probabilities, and risk curves. This is where capital moves before the story is written. And sometimes that movement sends a signal so subtle, most people don't notice it until it's too late. Because here's the uncomfortable truth. The biggest money in the market doesn't chase what's popular. It quietly rotates away from what everyone already believes in and toward what's about to matter next. A trillion-dollar giant, a name every investor knows, and yet capital is being trimmed, not out of fear, not out of doubt, but out of precision. At the same time, another company, far less understood, far more controversial, is seeing money flow in. This isn't a gamble. This isn't hype. This is a calculated shift toward data, intelligence, and asymmetric upside. So the real question isn't what is being bought or sold. The real question is, what does the smart money see that the rest of the market is still missing? Stay with me, because once you understand the logic behind this move, you'll never look at safe stocks and risky stocks the same way again. Capital doesn't move on emotion. It moves on probability, timing, and asymmetry. Every quarter, portfolios are stress-tested against a single question. Where does incremental capital earn the highest risk-adjusted return from here, not from 5 years ago? That question is what drives decisions that look dramatic from the outside but feel routine inside the process. When a position is reduced in a company that the market considers untouchable, it's rarely a judgment on quality. It's a recognition of maturity. Large, dominant platforms deliver consistency, scale, and resilience, but they also carry gravity. Their growth compounds, but it does so within known boundaries. Margins stabilize, expansion slows, expectations become priced in long before the next dollar of revenue arrives. At that stage, capital must justify staying put rather than working harder elsewhere. Portfolio management at scale is not about loyalty to names, it's about opportunity cost. Holding a position means saying no to every alternative competing for that same capital. When a company reaches a phase where upside is incremental rather than exponential, trimming exposure becomes rational, not contrarian. You don't exit strength. You rebalance around it. At the same time, emerging platforms with accelerating fundamentals demand attention. When revenue growth is inflecting, when operating leverage begins to show up in real numbers, when customer concentration shifts from experimental to institutional, that's when capital starts leaning forward. Those moments are brief, and they're often uncomfortable because valuation looks expensive right before it looks obvious. The market tends to misunderstand this dynamic. It frames reallocations as binary choices, confidence versus doubt, belief versus disbelief. That framing is lazy. Sophisticated capital allocation is layered. It recognizes that one business can remain exceptional while another offers superior forward returns. Reducing exposure is not an indictment, it's a recalibration of expected value. There's also a structural component most people miss. Large platforms are owned by everyone. That ubiquity compresses alpha. When ownership is crowded, the room for surprise narrows. In contrast, companies transitioning from niche relevance to core infrastructure create informational edges. The market is still forming its narrative. That's where mispricing lives. This is why portfolio shifts often coincide with broader thematic changes. Capital follows where complexity is rising fastest. As decision-making systems become more data-driven in real time, platforms that sit closer to the nerve center of those decisions command a different kind of premium. They're not just selling products, they're embedding themselves into workflows that are costly to unwind. None of this happens impulsively. Positions are adjusted incrementally, measured against liquidity, volatility, and correlation. Risk is not eliminated, it's redistributed. The goal isn't to predict the future perfectly, it's to ensure the portfolio benefits disproportionately if the future unfolds in a particular direction. From the outside, it looks like a bold bet. From the inside, it's simply capital doing what it's supposed to do, moving from certainty toward convexity, from scale toward acceleration, from what is universally understood toward what is still being underestimated. Markets don't reward technology for existing, they reward it for changing behavior. The difference between a company that sells tools and one that reshapes decision-making is where long-term value is created. That distinction matters more today than at any point in the last decade because we've moved past the era of experimentation and into the era of deployment. What separates advanced data platforms from conventional software businesses is not just artificial intelligence, it's integration. The most valuable systems don't sit on the edge of an organization, they sit at its core. They absorb fragmented data, resolve contradictions, and convert uncertainty into actionable clarity. When that happens, technology stops being an expense line and starts becoming a strategic asset. Budgets follow that shift. Growth accelerates when customers stop asking if a platform works and start asking how fast they can scale it. That transition is visible in revenue quality. Contract duration extends. Renewal rates improve. Use cases expand horizontally across departments instead of vertically within a single function. At that point, growth is no longer driven by sales momentum alone. It's driven by dependency. This is where the market often underestimates what it's seeing. Traditional metrics struggle to capture the value of platforms designed for complex environments. These businesses don't optimize for simplicity, they optimize for precision under pressure. Their customers operate in domains where bad decisions are expensive and slow decisions are unacceptable. That creates unusually sticky relationships. Even when pricing power increases, artificial intelligence amplifies this effect. Not because AI is novel, but because it changes the speed and scale at which insights are generated. When AI is embedded directly into operational workflows rather than layered on top as an add-on, it becomes a force multiplier. Efficiency gains are measurable, outcomes improve, and once those gains are realized, reverting to legacy systems becomes irrational. Financial performance starts to reflect this reality. Margins expand as implementation costs decline relative to revenue. Profitability emerges not through cost cutting, but through operating leverage. That's the signal long-term capital watches most closely. Growth that doesn't require proportional investment to sustain. There is also a geopolitical dimension investors ignore at their own risk. Data sovereignty, national security, supply chain resilience, these are not cyclical concerns. They're structural, platforms that operate comfort. Ably at the intersection of government, defense, and regulated enterprise are positioned differently than consumer-facing tech. Their demand is less sensitive to sentiment and more aligned with policy and long-term institutional planning. None of this suggests inevitability. Execution still matters. Expectations still need to be managed. Valuation always imposes discipline, but when a company demonstrates the ability to convert technological complexity into scalable, repeatable outcomes, capital begins to assign it a premium that isn't easily reversed. This is not about chasing narratives or riding momentum. It's about recognizing when technology crosses a threshold, from promising to indispensable. That's when growth stops being optional for customers and starts becoming embedded in how they operate. And when that happens, the opportunity set expands far beyond what traditional models anticipate. In markets driven by information, advantage accrues to those who control how information becomes action. That is where sustainable growth lives and where forward-looking capital tends to concentrate. Markets love simple stories, but capital operates in nuance. When money is reallocated from a household name, the immediate assumption is that conviction has shifted. In reality, what's shifting is emphasis. There's a meaningful difference between questioning a company's future and adjusting how much exposure that future deserves relative to other opportunities competing for the same capital. Large, diversified platforms are extraordinary businesses precisely because they've already won. They operate at global scale, dominate multiple verticals, and generate cash flows that smaller competitors can't replicate. That strength, however, comes with a trade-off. As businesses grow broader, each additional unit of growth contributes less to overall acceleration. The law of large. Numbers isn't a criticism, it's mathematics. Reducing exposure in a mature leader is often about recognizing where marginal returns flatten. When expectations are high and visibility is strong, upside tends to be linear. Downside, however, can still be nonlinear if growth disappoints even slightly. Managing that asymmetry is not pessimism, it's discipline. What's often misunderstood is that conviction can remain intact even as position size changes. A company can still be admired, trusted, and strategically important, while no longer being the most efficient deployment of incremental capital. Portfolio construction requires constant comparison, not absolute judgment. Every position must earn its weight. There's also the question of where innovation is priced versus where it's already been realized. Mature platforms invest heavily in future technologies, but the market tends to discount those investments immediately. The optionality is recognized before it materializes. That compresses the upside available to new investors and limits the benefit of adding exposure at current valuations. By contrast, emerging leaders in specialized domains often operate under a different perception. Their risks are magnified in the narrative while their progress is discounted. That imbalance creates opportunity, not because the risks aren't real, but because they're already reflected in sentiment. When execution proves consistent, repricing can be swift. Another factor is flexibility. Large platforms are optimized for scale and stability. They move deliberately, which is appropriate for businesses with global footprints. Smaller, more focused companies can pivot faster, deploy resources with precision, and align product development directly with customer demand. In fast-evolving technological environments, that agility has tangible value. Importantly, this isn't a zero-sum view of the market. It's entirely rational to maintain exposure to dominant platforms while reallocating toward higher growth vectors. Diversification is not dilution when it's intentional. It's risk management aligned with opportunity recognition. The market's fixation on binary outcomes, bullish or bearish, misses the sophistication of how capital is actually deployed. Decisions are rarely about replacing one belief with another. They're about weighting probabilities, adjusting for changing conditions, and ensuring the portfolio remains positioned for what's emerging, not just what's already established. Ultimately, reallocating capital away from maturity and toward acceleration is not a statement of doubt. It's a recognition of where the next marginal dollar works hardest. And in competitive markets, marginal efficiency is where long-term performance is determined. Strong businesses don't need blind allegiance. They need measured confidence. And measured confidence is expressed not in words, but in how capital is allocated over time. Valuation is where conviction meets reality. It's easy to talk about transformative technology and long-term potential, but capital ultimately answers to price. Every investment, no matter how compelling the narrative, carries a question that never goes away. What am I paying today for what I expect to receive tomorrow? That tension is not a risk to be avoided. It's the discipline that separates durable returns from temporary enthusiasm. High-growth companies are rarely cheap, and they shouldn't be. When a business is expanding rapidly, capturing strategic customers, and demonstrating operating leverage, the market assigns a premium. The mistake is not in paying that premium. The mistake is in ignoring what must go right to justify it. Valuation is not a static number. It's a set of assumptions about execution, timing, and scale in emerging platforms. Volatility is not a flaw. It's the price of admission. These companies operate closer to the edge of expectation, where small changes in outlook can produce large changes in price. That volatility can punish impatience, but it also rewards clarity. When fundamentals continue to improve beneath the surface, short-term dislocation becomes opportunity rather than threat. Risk, in this context, is often misdefined. It's not the daily movement of a stock. It's the probability that the underlying thesis fails to materialize. Managing that risk means constant interrogation of the data, customer concentration, contract durability, margin trajectory, and competitive moat. When those indicators remain intact, price fluctuations become secondary. There's also a behavioral dimension to valuation. Markets tend to extrapolate recent performance too far in either direction. Rapid appreciation invites skepticism, temporary pullbacks invite fear. Neither emotion is particularly useful. What matters is whether the business is compounding its advantage or merely riding sentiment. Long-term capital is indifferent to noise but ruthless about fundamentals. Importantly, paying attention to valuation does not mean avoiding ambition. Some of the most successful investments in history looked expensive at every stage of their ascent. What justified those prices was not perfection, but progress. consistent, measurable progress that expanded the addressable market and deepened customer reliance. At the same time, discipline requires acknowledging that not all growth is created equal. Revenue without margin is volume, not value. Expansion that relies on constant capital infusion is fragile. Sustainable growth shows up in unit economics first and scale second. When that sequence reverses, valuation becomes a warning rather than a signal. This is why position sizing matters as much as security selection. Exposure should reflect confidence adjusted for uncertainty. When expectations are elevated, prudence dictates flexibility. When fundamentals outperform expectations, that flexibility becomes an advantage. Capital must be able to respond, not react. Ultimately, valuation is not about predicting the future with precision. It's about ensuring the future doesn't need to be perfect for the investment to work. The best opportunities are those where success can be partial, timing can be imperfect, and returns can still be compelling. That balance between optimism and restraint is where sophisticated capital operates, not avoiding risk, not chasing certainty, but allocating with an understanding that volatility is inevitable and discipline is non-negotiable. At the highest levels of capital allocation, investing is less about prediction and more about process. Outcomes matter, but they are downstream of decisions made under uncertainty. The advantage doesn't come from being right more often than others. It comes from managing risk more intelligently when everyone else is focused on return alone. Large portfolios are living systems. They evolve continuously in response to liquidity, correlations, macro signals, and structural shifts in the market. Nothing is static. Every position interacts with others, amplifying or dampening overall exposure. That's why adjustments are constant. Waiting for certainty is not a strategy, it's a liability. Risk management is often misunderstood as defensiveness. In reality, it's what allows capital to stay aggressive over long periods of time. By controlling downside, portfolios retain the flexibility to pursue upside when opportunities emerge. Without that discipline, even correct ideas can become damaging if they're sized or timed poorly. One of the most important principles is diversification by driver, not by label. Owning multiple technology stocks doesn't create diversification if they respond to the same forces. What matters is how positions behave when conditions change. Does the return depend on consumer demand, enterprise spending, government policy, or data intensity? Different drivers reduce correlation and improve resilience. Rebalancing plays a critical role here. When a position appreciates significantly, it begins to dominate risk exposure. Trimming is not about locking in gains emotionally. It's about restoring balance mechanically. Allowing any single position to dictate portfolio behavior introduces fragility, regardless of how strong the underlying business may be. There's also a temporal element to risk that rarely gets enough attention. Some investments carry short-term uncertainty with long-term clarity. Others appear stable until they're not. Effective capital allocation distinguishes between volatility that is informational and volatility that is structural. The former can be tolerated, the latter must be avoided. This is particularly important in periods of technological transition. As new platforms emerge, correlations shift and historical relationships break down. Models must adapt. Assumptions must be challenged. What worked in the last cycle is not guaranteed to protect capital in the next one. Flexibility becomes an asset in itself. Importantly, risk management does not mean avoiding concentration when conviction is high. It means earning the right to concentrate by understanding failure modes in advance. Where does the thesis break? What indicators would signal deterioration? How quickly can exposure be reduced if conditions change? These questions are answered before capital is committed, not after. The goal is not to eliminate drawdowns. That's unrealistic. The goal is to ensure drawdowns are survivable and recoverable. Longevity in the market compounds advantage. Those who can stay in the game through volatility eventually benefit from opportunities others are forced to pass on. In the end, successful investing is not about bold statements or public conviction. It's about quiet, consistent execution. Capital that is managed with humility, discipline, and adaptability doesn't need to be right all the time. It just needs to be positioned so that when it is right, the impact is meaningful. And when it's wrong, the damage is contained. And this is where the story really sharpens. Markets don't reward comfort. They reward anticipation. By the time an opportunity feels obvious, the advantage is already gone. What separates extraordinary outcomes from average ones is not information, it's interpretation. Capital doesn't ask which company is bigger, it asks which company is becoming more important, which one is moving closer to the center of decision making, which one gains leverage as complexity increases, not decreases. That's the difference between owning what already dominates and positioning for what could redefine dominance. This isn't about abandoning giants or worshiping newcomers. It's about understanding cycles, recognizing inflection points, and having the discipline to act before consensus catches up. Because when the next chapter of this market is written, it won't be led by the loudest headlines. It will be led by the quiet reallocations that happened long before anyone was paying attention. So the only real question left is this: will you wait for certainty, or will you learn to see what the market is whispering before it starts shouting? Stay alert, stay analytical, because the next big move is never announced in advance.